Welcome to China Watch. Since the pandemic, China's economic situation has worsened significantly. Not only are foreign companies and investors withdrawing from the Chinese market, but domestic enterprises and capital are also leaving to seek investment and trade opportunities abroad. In the first half of 2024, China's outbound investment and international trade reached record highs. But how much further can this path go?
Chinese capital currently faces significant challenges. On one hand, China's domestic consumption market is experiencing a severe depression. Individual consumption has drastically shrunk, and local governments have no money to invest or spend. On the other hand, internationally, high tariffs are being imposed on Chinese goods. Furthermore, the domestic capital market continues to decline, while stock markets in countries like Japan, Taiwan, and the United States keep reaching new highs. Chinese capital is seeking opportunities abroad through various channels. This video focuses only on Chinese enterprises' outbound investment, excluding the securities market and the vast amount of gray capital fleeing the country. Foreign investment accelerated its withdrawal in 2023. That year marked the first in over a decade when foreign investment in China decreased. According to the Ministry of Commerce of China, the total foreign direct investment fell to 1.13 trillion yuan, about $146 billion. According to data from the Chinese government website, the actual use of foreign capital in the first half of 2024 amounted to 498.91 billion yuan, equivalent to less than $70 billion, representing a 29.1% year-on-year decline, signaling an acceleration of foreign capital withdrawal. Data from the Ministry of Commerce show that by the end of April 2004, China's cumulative contracted foreign investment amounted to $990.13 billion. At that time, $1 trillion was equivalent to far more than $20 trillion today. According to a report from the United Nations Conference on Trade and Development, China attracted more than $100 billion in foreign investment for the first time in 2010, ranking second globally and first among developing countries. Hong Kong also climbed to third globally in foreign investment absorption. For more than a decade thereafter, China attracted over $100 billion in foreign investment annually, making foreign capital a key driver of its economic boom. However, China's deteriorating human rights record in Hong Kong, Taiwan, Xinjiang, and other regions has rapidly worsened its international relations. In recent years, the trend of foreign investment in China has reversed. Recently, Din Tai Fung, a well-known Taiwanese restaurant chain that had been operating in mainland China for 20 years, announced it would close 14 of its stores in China by October 31, 2024, and lay off about 800 employees. Similarly, tech giant IBM recently announced it would shut down its research department in China, with over 1,000 layoffs. Automotive giants like Toyota, Mitsubishi, Honda, Nissan, and Hyundai are all scaling back their operations in China. These departures are not isolated incidents, but reflect a broader pessimism among foreign companies regarding the Chinese market.
On the trade front, high tariffs are increasingly being imposed on Chinese goods internationally. Since 2000, China had earned massive profits by leveraging the global market. The international community initially hoped that economic prosperity would drive China's democratization, but this hope has since faded, and the doors to the global market are beginning to close for China.
In response to the domestic consumption slump and international tariffs on Chinese goods, Chinese companies have opted to invest and build factories abroad. In 2020, for the first time, China ranked first globally in outbound direct investment, reaching approximately $153.7 billion, up 12.3% year-on-year. This investment accounted for over 10% of the global total for 5 consecutive years, reaching 20.2% in 2020. By the end of 2020, China's cumulative outbound direct investment had reached $2.58 trillion, ranking third globally, with a global share of 6.6%. China's outbound direct investment had surpassed the scale of foreign investment it attracted. In the first half of 2024, China's outbound direct investment reached $85.3 billion, up 13.2%. Non-financial outbound direct investment amounted to $72.6 billion, a 16.6% increase, with $15.46 billion invested in Belt and Road Initiative partner countries. Chinese companies' accelerated foreign investments mean that jobs that should have been created domestically are now flowing overseas, weakening the vitality of the domestic economy. According to the Secretariat of the Vietnam Chinese Chamber of Commerce in Ho Chi Minh City, as of March 2024, more than 4,000 Chinese companies had registered in Vietnam, with a total capital of over $27.6 billion. In 2023 alone, Chinese companies invested $4.5 billion in Vietnam, an increase of nearly 80% compared to 2022. China is the fourth largest investor in Vietnam, after Singapore, South Korea, and Hong Kong. The goods produced in Vietnam can be exported to the United States with almost zero tariffs. For many years, the US has been Vietnam's largest export market. Moreover, Vietnamese goods can enter the ASEAN market, with a population of about 800 million, without tariffs. In contrast, Chinese goods face tariffs of 25% or even 100% when exported to the US amid the US-China trade war. Chinese companies building factories in Vietnam can take advantage of zero tariffs to export goods to the US, the European Union, ASEAN countries, and others.
In 2023, China surpassed Japan for the first time to become the world's largest auto exporter. According to data released by Mexico's Statistics Agency and the Mexican Association of Automobile Distributors in January, Chinese automobile brands such as BYD, JC Motors, and Geely sold nearly 130,000 vehicles in Mexico last year, a year-on-year increase of 63%. These brands captured 19.5% of the Mexican market.
Automobiles manufactured in Mexican factories can enter the US with a minimal 2.5% tariff. If they meet the stringent local content standards of the 2020 USMCA agreement, they may even be exempt from tariffs altogether. By contrast, Chinese-made electric vehicles face a 27.5% tariff when imported into the US. According to data from the Mexican government, Chinese direct investment in Mexico reached a record high of $587.2 million in 2022. BYD, SAIC Motor, and Chery all plan to build factories in Mexico by 2024. On February 23, the U.S. Manufacturing Alliance reported that allowing cheap Chinese cars into the U.S. market could eventually destroy the U.S. auto industry. The organization argued that the U.S. should prevent Chinese companies from benefiting from the U.S.-Mexico-Canada Free Trade Agreement, USMCA. Before large-scale closures and unemployment occur in U.S. factories, it is essential to close the back door for Chinese automobile imports. In April, Reuters cited Mexican officials who stated that the Mexican federal government, under pressure from the U.S., has maintained a distance from Chinese automakers, refusing to offer incentives such as low-cost public land or tax breaks for Chinese car manufacturers to produce electric vehicles locally.
It seems that the outlook for Chinese companies' foreign investments is also uncertain. Currently, anti-China sentiment is high in the U.S., and presidential candidates from both parties are competing over tariff rates on Chinese goods. It may become increasingly difficult to circumvent tariffs through foreign investments.
On August 2nd, the U.S. Department of Commerce rejected Vietnam's request to be recognized as a market economy. Opponents argue that Vietnam poses an increasing threat to U.S. manufacturing as more Chinese companies set up factories there to avoid tariffs on Chinese imports. Chinese capital is leaving China at an accelerated pace, hoping to integrate into the global market. However, due to concerns about the Chinese Communist Party, the international community will likely block Chinese companies abroad. Regarding foreign trade, China's import and export data for the first half of 2024 reached a historic high. Data from the General Administration of Customs show that in the first half of 2024, China's total value of goods traded reached 21.17 trillion yuan, a year-on-year increase of 6.1%, surpassing 21 trillion yuan for the first time. Exports grew by 6.9%. Although China's export value continues to grow, it faces severe challenges. The international community generally believes that China's practice of dumping goods at any cost into the global market will destroy its own industries. As a result, many countries have begun imposing higher tariffs on Chinese goods. For example, Chinese electric vehicles face tariffs as high as 37% in the European Union, reflecting international distrust of Chinese products and dissatisfaction with its non-market practices. Brussels has explicitly stated that these tariffs are a response to Beijing's long-standing unfair subsidies to electric vehicle manufacturers.
China's manufacturing value added surpassed the U.S. for the first time in 2010 and has remained in the lead since then. However, with the deterioration of the CCP's relations with the international community and the imposition of high tariffs, China's manufacturing advantage will slowly erode. The highly developed industrial chain that China has built over 20 years will face rapid collapse.
Currently, 70% of Chinese household wealth is tied up in real estate, which is continuing its march toward disaster. Goldman Sachs even predicts that Chinese real estate prices will fall by 40% by 2025. In 2020, China's land sales revenue reached 8.4 trillion yuan, accounting for 55% of local government revenue, but in the first half of this year, land sales revenue was only 1.5 trillion yuan, a cliff-like drop. The number of foreclosed homes continues to reach new highs, with 202,000 homes auctioned in the first half of this year, an increase of 12% compared to the same period last year. Rent prices continue to fall, and office building vacancy rates are rising. Although Beijing has launched a series of stimulus policies, including interest rate cuts and home purchase subsidies, these measures have failed to reverse the market downturn. More worryingly, the massive debts owed by real estate developers will push several financial institutions toward bankruptcy. Local governments, facing declining revenue from the real estate market, are also struggling to pay their employees' salaries. The loss of wealth has made Chinese consumers even more reluctant to spend. The CCP government, which has always treated its people as expendable, is not stepping in to help them through these hardships. Instead, it is squeezing more from the public, as evidenced by the recent housing pension policy, which aims to extract wealth from the people to maintain the regime's survival. Consequently, the outlook for China's domestic consumption market is extremely bleak. China's vast manufacturing sector is currently seeking an outlet through foreign investments and exports. However, with the CCP's conflict with Western democracies escalating and both U.S. parties prioritizing anti-communism, how much further can Chinese companies and capital go internationally? To investors and entrepreneurs, avoid investing in China at all costs.